Hi, this is Dr. Matecki back with part 2 of chapter 3 from Mankiw's Macroeconomics. So far we've talked about the supply side of this model of the macroeconomy that we're developing. We've talked about the production function, the factor markets, and the prices in the factor markets, the real rental rate of capital, and the real wage. Now we're going to talk about the demand side. So the supply side talks about the production of goods and services, and the demand side talks about who's going to actually purchase and use these goods and services. So everything that's produced in the economy is going to be purchased and used either by consumers, households, that's the C, consumption. It's going to be purchased by businesses, which is the investment component, or it's going to be purchased by the government sector. So now we're talking about a closed economy, so we don't have people in other countries purchasing things, but that's obviously an option as well. But we're sort of ignoring that international sector for this chapter. Later we'll talk about it. So we're going to talk about equilibrium in two different markets. Remember, we talked about the notion of general equilibrium, so equilibrium in all the factor markets, and also the goods markets and the loanable funds market, and what that means to be in equilibrium. First component of aggregate demand is consumption, and this is also by far the largest segment. So historically, about 70% of spending is done by households in the form of consumption spending. So what drives consumer behavior? Well, we'll talk a little bit about some of the nuances later, but for now, we're going to have a relatively simple description of how consumers make purchasing decisions. And so we're simply going to say that consumption is related to disposable income, which is all the money, all the income that you have left over after you pay your taxes. In other words, remember, Y can stand for output or income. In this case, we're thinking of Y as standing for income. So total income minus total taxes will give us the total disposable income in the economy. So the consumption function is a mathematical relationship that shows us how consumption depends on disposable income. So in this case, we're saying that is, Y minus T is the only factor that's just that's driving consumption, and that's probably not the most realistic, but for this model, it works. So the marginal propensity to consume is an important concept that we'll talk about throughout this semester. So this is the change in consumption when disposable income goes up by $1. So if you earn $1 of additional income, that's the idea of marginal. It's the next dollar. So the next dollar you earn, if you tend to consume about 70 cents, then your marginal propensity to consume would be 0.7. It's also important to note that if you're not consuming a fraction of that next dollar, then that's going to go to savings. So the marginal propensity to consume is the same as 1 minus the marginal propensity to save. Just real quickly, you've seen this before in Principles of Macro, but the consumption function, if we were to graph that mathematical relationship on the previous slide, with disposable income being on the variable on the x-axis and consumption, the variable on the y-axis, we would get an upward sloping relationship that looks something like this. So as disposable income gets larger, the amount you're consuming gets larger in a predictable fashion. So now it's also important to note that the marginal propensity to consume is the slope of this relationship that we call the consumption function. So remember, what is the slope of a line? Well, it's the delta y. It's the change in y over the change in x. So what the slope is telling us is how much consumption changes for a $1 increase in disposable income. That's the slope of this line. Also note that the consumption function looks kind of flat, so it's never going to be super steep. If the slope is the fraction of the next dollar that you consume, it's never going to be over 1. And typically it's going to be somewhere in the range of 0.6 to 0.8 based on typical data. The next component of spending is investment. Now, be careful when you use the term investment in macroeconomics, because a lot of people think immediately, people putting money into the stock market or in bonds or something like that when they think of investment. But that usage of the word investment is what we would call savings as economists. So if an individual has money left over after they consume, then they have some money that they can put into some sort of account that becomes funds that are available to borrowers in financial markets. Investment in the context that we're currently examining refers to purchases of final goods and services by businesses. So if they were to buy tools and machines or build a factory or um, you know, build up inventories, those things are considered investment. So final purchases of goods and services by businesses is typically in the range of 15 to 20%. So much smaller than consumption. It's also much more volatile. So when we have recessions or expansions, investment tends to be the component that moves a lot. So what drives business behavior? Well, businesses are sensitive to the interest rate. So in this model, we are assuming that investment is solely a function of the real interest rate, which is denoted with the little r. So remember, don't confuse this with the big R, which is the real rental rate. So the real interest rate, again, is the interest rate corrected for inflation. So the interest rates you just see out, on the online or at your bank, those are nominal interest rates. The real interest rate, again, we want to correct for the effective prices to understand the real cost of using investment funds. So we always want to look at the real interest rate. So the interest rate, the real interest rate is the cost of borrowing. So if a firm wants to build a factory, they might not have all the cash on hand, or they may not want to use it. So they might borrow from someone. So the interest rate is the cost of borrowing. But remember, even if you use your own funds, there's an opportunity cost. So if you don't use your own funds for the factory, you could put those in a bank and earn the rate of interest. So in the real world, there are all sorts of different interest rates. In this model, we're sort of simplifying it and saying there's one interest rate. But again, that's a simplification. So if the interest rate is high, then firms aren't going to want to invest as much because it's expensive to borrow or to sacrifice the earning power of your own cash. So high interest rate means low investment and vice versa. So what we're going to end up with is an inverse relationship uh, between the real interest rate and the quantity of investment. If we convert that relationship to graphical form, we get this downward sloping relationship between the real interest rate R and the quantity investment I. If you're saying, hey, that looks like a demand curve, well, you're right. This is a demand curve. This is a relationship between the quantity of investment and what is essentially the price of investment. So this investment function here is indeed the demand function for investment. For any given real interest rate, the investment function tells us the quantity of investing that the firms are willing and able to engage in. Government spending is the final component of spending in this model. So this also can be a little bit confusing. So government spending is the purchase of final goods and services by the government sector. So the big thing to keep in mind is that government spending, government purchases, if you were to look at the national income and product accounts online for the government accounting website. So you would see that government spending excludes lots of things that we typically think of as government spending. So, for instance, Social Security benefits, unemployment benefits, right? Things like Medicare and Medicaid. These things are not considered government purchases, these are considered transfer payments. So the government collects taxes from people and then uses it to fund these services that end up in final purchases, of things like medical goods by consumers. So they're transferring money from one person to another. They're not actually purchasing a final good and service, good or service, excuse me. So if you look up numbers for government spending, you're going to see numbers that are much higher than what is actually considered government purchases, because oftentimes people are lumping transfer payments into what they're considering government spending. So actual government purchases are more like 20% of GDP, not the 30 to 40% you may see when you look at government spending online. So in this model, what determines government purchases? Well, we are making a very strict assumption here. We're just saying that G, government spending, and T, taxes are fixed at some level, G bar and T bar. So these are determined by the political process, so they're outside of the sort of scope of this model. So now we could build a more complex model that describes how the government decides how much to spend in tax and those sorts of things. But again, that's well beyond the scope of this particular chapter. So we're going to simplify and just assume that there's some amount of government spending and taxes, and not that that number can't change. We can still analyze what happens when government spending and taxes change, but we're assuming that these variables are exogenous in the sense that they are determined outside of the model that we're building. So now that we've described all the components of aggregate demand, we simply need to put them all together. So aggregate demand is just another way of saying total demand in the economy. So in this case, demand in the economy comes from consumers, consumption, from businesses, that's the investment spending, and from the government sector, that's our government purchases. So aggregate demand is just the sum of consumption, investment, and government spending. Aggregate supply we've talked about in the other video, and this is just described by the production function. So given that we have a fixed amount of capital and labor, we're going to have some fixed amount of output produced according to the production function, and that fixed output is Y bar. So now the notion of equilibrium. Think back to Eco 201 when you had equilibrium in the supply and demand model. Equilibrium occurs where quantity supplied equals quantity demanded. That's the exact same thing that we're going to do here. So we're simply setting supply equal to demand to form our equilibrium condition. So now this equilibrium condition that's described in this line here, this can be used to solve a variety of problems. So one common problem is to figure out what the real interest rate needs to be in order to ensure equilibrium. What's the equilibrium real interest rate? Well, this is kind of like the price in the traditional supply and demand model. So remember, the market price goes up or down in order to ensure that we reach equilibrium. That's the same thing that the real interest rate is doing here. So this real interest rate serves the role of the price in the traditional supply and demand model. So one type of problem might ask, all right, so given that consumption follows a certain consumption function, and we have an explicit investment function that's includes specific numbers, and we have an amount for government purchases, and we have an amount for taxes. Plug all those values into this equilibrium condition and solve for the real interest rate. And then see what happens when government spending goes up or taxes go up or down, right? So, or what happens when the investment function changes a little bit or the consumption function changes a little bit. So those are all sorts of problems that involve plugging values into this equilibrium condition and solving for the real interest rate. There is a separate video posted that already goes through the loanable funds market in quite a bit of detail. So I'm not going to spend a lot of time going through the building of this model. But again, this is the final market that comprises this model. So this is a model of the financial system, and so again, this is a supply and demand story. So there's one asset. We refer to this as loanable funds. So the demand for loanable funds comes from businesses and consumers that are investing in new housing construction, but primarily this is business spending. So firms demand investment. The supply of loanable funds comes from households and potentially the government sector that is contributing to savings. And the price of the funds is the real interest rate. So again, think of this as a typical supply and demand framework. While I'm not going to go into the building of the loanable funds model in this video because it's in the other video, I do want to talk about savings in a little bit more detail. So again, the supply of loanable funds comes from savings. So what is saving? So households, if they don't consume all of their income in a given period, then what do you do with it, with the leftover, right? So a lot of people will put some of this into savings accounts or checking accounts at the bank. You can put these into brokerage accounts, something like E-Trade, or you can have this invested through your 401k. So oftentimes households are purchasing bonds and stocks and other financial assets. So in any case, whether people put money into a savings account or into the stock market, these funds become available um, for firms to finance investment spending. So whether it's borrowing or equity, there's different ways that firms can finance investment spending. Uh, but the key thing to realize is that people that don't spend all of their money have some left over. It then becomes available to firms through financial markets, with the help of banks and other financial firms that act as what we call financial intermediaries. The government can also contribute to saving if it does not spend all of the tax revenue it receives. However, it's been a while since the government has had surpluses, like a little bit in the late 90s. There were a couple of years where there were surpluses. Generally speaking, the government has been borrowing and borrowing a lot recently. Typically, the government is sucking savings out of the system as opposed to contribute to savings. So the government's net saving is typically negative if we look at the data. So the different sources of savings in this model, we have private saving and public saving. When we add these two things together, we get total saving, which we refer to as national saving. So private saving is what's left over after we give our taxes to the government and we have consumption spending. So whatever's left over after we buy all the stuff we want to buy and we give our money to Uncle Sam, that is private saving. Public saving is the difference between taxes collected and government purchases. So if taxes exceed government purchases, then we are running a surplus. If taxes are less than government spending or government purchases, then we are running a deficit. So if we're running a deficit, then we are contributing to the national debt. If we are running a surplus, we are paying off some of the national debt. So national saving, we refer to this as S in this model. Again, this is just adding these two things together. So here's private savings. We're going to add that to public saving. When we do that, the T's just cancel each other out. We have a negative T here, a positive T here. So our final expression for national saving is Y minus C minus G. So whatever is left over from all of our production after we consume and have government purchases. Another way to think about national saving is the total funds available for investment purposes. It's also important to keep in mind that savings can come from foreigners too, even though we're not considering that in this model. But certainly people in other countries that are not consuming all of their income can funnel some of their savings into global financial markets or U.S. capital markets. And that provides additional funds that can be used for investing. So even if U.S. citizens aren't saving very much, maybe some other countries are saving a lot, and we can tap into their savings. So I already mentioned the idea of a budget surplus or a budget deficit. If it happens that T is equal to G exactly, we have what we call a balanced budget. Public saving is equal to 0 in that case. So don't confuse a balanced budget with optimal fiscal policy. Remember, fiscal policy is just a term that describes the spending and taxing behavior of the government. So in a sense, a balanced government, yes, we're not running big deficits, which aren't necessarily desirable, but there are perfectly good circumstances when we may want to run a deficit. For instance, if we're in a recession or if we want to invest in infrastructure or those sorts of things, those are perfectly reasonable reasons to borrow. So don't confuse balanced budget with optimal budget behavior. So if there is a budget deficit, then in order to spend as much as the government is spending, they're going to have to get the money from somewhere. So they have to borrow it. So in other words, they finance their spending through deficits, or their deficit spending through borrowing. And so in order to borrow money, they issue treasury bonds. So in other words, these are a way that the government essentially borrows money from the private sector. So in exchange for some cash, the government gives you a treasury bond, and the bond requires that the government pay you back in the future that amount of money plus interest. So it's just like a typical loan. Government spending has been in the news a fair amount in recent times. If you look at this graph, you'll see why. So, well, a couple things jump out. So when we're looking at U.S. federal government surplus deficit from 1930 to 2020, so notice on the y-axis, we're talking about a percentage of GDP. So the absolute dollar amount is not necessarily as important as the burden that the debt reflects. And so if you have a very large economy, you can have more debt than a small economy. So when we look at it as a percentage of GDP, we're saying, all right, how, as a fraction of the total amount of goods and services we're producing in a given time period, or the amount of income we're producing in a given time period, this is how much of that we are borrowing. So you can see in the early 1940s, we had huge deficits. No surprise there, because we had a war to fight and had lots of guns and tanks and things to produce, and needed resources to do that, to fund the war effort. So huge borrowing. You may have heard the term war bonds. So governments borrowed lots of money from the private sector. So after the war was over, this reversed, and we had more or less a balanced budget for quite a long time, until we hit the early 80s. Then this is where we started seeing pretty consistent deficits over time. So a large increase in spending in the 1980s. Again, this was a lot of defense spending. The economy was doing really well in the mid to late 90s, and we actually had a brief period of surpluses, and then big deficits followed. So you can see this is the financial crisis. Spent a lot of money around this time trying to fight the recession that happened in 2008. Deficits declining after that, after the economy recovers, and then of course with COVID-19 spending a lot of money again. So anytime you see this line below zero, this means the national debt is getting larger. So you can see since 1980, pretty consistently, we've been racking up more and more national debt. So this graph shows the federal debt, which is closely related to the deficits, right? So whenever we have deficits, we will see the debt expanding. So when the deficits were large in the other slide, right, the debt was climbing. Once we returned to normalcy after the war, the debt to GDP ratio declined. So again, keep in mind, we're talking about as a percentage of GDP. So what this meant is if GDP were 5 trillion in this year here, then we would be borrowing, or excuse me, we would have a total debt that is 120% of $5 trillion at that particular point in time. So debt to GDP ratio of 120% back in the time of World War II, dramatically declining through about 1980, and then we see a pretty steady upward climb of the national debt. We've recently eclipsed the 100% of GDP mark in terms of total debt. So this is pretty staggering if you think about the amount of money that we have borrowed, the accumulated debt. However, I don't think we're at the point of considering this to be a crisis. So really, it depends on your economy's ability to repay this debt. And at this point in time, it does not appear that we are in any sort of position where we are not able to pay back this debt. Certainly, we would see signals in the financial market if people thought we were not going to be able to pay back our debt and we were headed for default. So it would seem like the government has quite a bit of power to tax out there that they haven't taken advantage of. So if we really had to raise taxes to pay back the debt, we could. I think the bigger concern that a lot of people have is the long run projection. So Social Security spending, Medicare spending is projected to rise, and so we could see even much further increases in the size of the debt. So there isn't any magic debt to GDP ratio that indicates we're in crisis. It really has to do with your economy's ability to repay it. At this point in time, even 100% of GDP is not something that is insurmountable. But certainly, if this trend continues and we start seeing 150 or 200% of GDP, then we might have more reason for concern. So again, it's about the long run financial outlook, and the sort of bleakness that we see in some of the projections that are a genuine concern. I just want to talk about this slide briefly because I think it could be confusing. So what this slide tells us is that equilibrium in the LF, this is the loanable funds market, implies that there's also equilibrium in the goods market and vice versa. So if we are in equilibrium in the goods market, then we are automatically in equilibrium in the loanable funds market and vice versa. And that's just because of how we have defined our variables here. So our components of spending are C, G, and I. And so if we are talking about the loanable funds market, equilibrium means that savings is equal to investment. Well, what is saving? Y minus C minus G, right? This is our saving. Savings is equal to investment. We see that if we just simply rearrange these components here using a little bit of algebra, this also implies that Y equals C plus I plus G. In other words, this is supply equaling demand in the goods market. So equilibrium in one market automatically means that we're in equilibrium in the other market. I want to highlight this case study in the text. There are lots of these throughout the course of the semester, and these are really good things to read because I think it's important to be able to apply these concepts in the theory to real-world situations. This is exactly the sort of skill that I would like you to get out of this course. Take something that happens in the news or a current event or some sort of policy that's being discussed or debated, and use the economic theory to understand the situation and predict what's going to happen to the key variables that drive our behavior. So let's look at this instance in the early 1980s. So I mentioned in the previous slide, this was a time when we had an increase in government spending. There's a big increase in defense spending, but also some entitlement spending as well. There were also tax cuts that were designed to increase consumption and investment spending to have some positive impact on economic growth. So the combination of collecting fewer taxes and having more government spending meant that we were running deficits. So both of these policies, the increase in government spending and the decrease in taxes, act to reduce national savings. So if we have a bigger G, we're subtracting a larger amount. Remember, S is Y minus C minus G. G is bigger, we're subtracting a bigger amount here. That means that S is going to go down. If we are decreasing taxes, then disposable income is increasing, which means consumption is increasing. So taxes going down means consumption goes up. If consumption goes up, again, we're subtracting a bigger number here. And this also causes savings to go down. So the end result here is that we'll have less funds available for investment. If you think about the supply and demand model, a decrease in supply, what's going to happen there? Well, we'd expect there to be an increase in the price and a decrease in the quantity. And in fact, when we look at the diagram, that's exactly what happened. So a decrease in supply, remember from Eco 201, this is a leftward shift in the supply curve. So if we start off in the initial equilibrium at the intersection of the supply of loanable funds and the demand for loanable funds, which is the investment function, the equilibrium determines the real interest rate, which is the price in this market. So the supply curve shift to the left causes the equilibrium point to shift from here to here. At the new equilibrium, the real interest rate is higher. So the overall impact of these changes in fiscal policy, the increase in government spending and the decrease in taxes, means that we will have less investment, right? So the quantity of investment in equilibrium has decreased and we have a higher interest rate. So the decrease in savings leads to a higher interest rate, which causes firms to demand a lower quantity of investment. So why would we care about lower investment and higher interest rates? Well, remember the purpose of investment in many cases is to purchase things that help businesses become more productive. If we have more tools and more machines and more factories, then that allows the economy and the workers to be more productive. And so, more productive workers, remember, what did that lead to? And some other slides we talked about, that leads to higher GDP and higher wages. And so, investment is an important thing to consider when we're talking about the long run performance of the economy and increasing the standard of living of people over time. So, when we have some theory that suggests something might happen to a variable, the thing we should always do is, well, let's look at the data. Did the data match what we're predicting in the theory? And so if we look at, just some simple figures here with respect to savings, interest rates, and investment, certainly we tend to see, the data matching what we would expect to see based on the theory. So you do need to be careful because in any given time period, there are many things going on, and there's not only fiscal policy, but there's monetary policy. So there are changes in the money supply which affect interest rates. So certainly the changes in government spending and taxes are not the only thing that are happening in this time period in the 1980s, but certainly this is evidence in favor of this hypothesis that comes out of the economic theory. So in the 1970s, overall this entire decade, we had still had some deficits, but not nearly as high as the 80s. So in the 1980s, deficits went up, not quite double, but close. So as a result, the total saving went down, just as the theory would predict. Also, as we would predict, the interest rate is much higher in the 80s as in the 1970s. So this is definitely going to be skewed because of monetary policy. So the Fed raised interest rates quite a bit in this time period to try to reduce the inflation that started happening in the 1970s. So keep that in mind, but certainly some of this increase in the interest rate was owed to the increase in government deficits. Now, one interesting thing to note here is that investment spending didn't decline that significantly, 19.9 to 19.4% as a percentage of GDP. So it does match the theory, but perhaps not as big a dip as what we would expect. And so part of the reason is because of what I mentioned before, that if we aren't saving in this country, then people in other countries might be saving, and we can tap into those savings. So a lot of what you see here is that the funds for investment were coming from abroad, not necessarily domestically, so that the dip in investment wasn't so severe. Right, and throughout the text, there are also lots of these now you try features in the slides. So this is a good reason to look through the lecture slides and not just read the text, because there's lots of additional practice that you can go through. So again, this is a big part of what I want you to be able to do as a result of taking this class, is to understand the basic economic theory, look at a potential policy change, and predict what's going to happen and understand why it's important. So for instance, the effect of savings incentives. Let's say the government passes a policy that makes it more attractive for individuals to save money as opposed to consume it. So we're assuming that tax laws are altered in some way, and so the total amount of T does not change. So we're collecting the same amount of taxes, but perhaps we're collecting different types of taxes. So if we implemented this policy, what would our diagram tell us is going to happen? So let's use the diagram, use the theory to come up with some predictions about what's going to happen to the change in the variables we care about. Excuse me, in particular, the interest rate and the level of savings and investment. We've already established that those are important things for the long run health of the economy. So let's use the diagram to see what's going to happen. So I'm just going to draw the diagram really quickly here. So on the y-axis we had R, the real interest rate. On the x-axis we had savings and investment. So a little sloppy, sorry about that. So remember, our investment function is a downward sloping relationship. So this is what we are calling I of R. So this is the demand for investment, inversely related to the real interest rate. And remember, our savings, we're just assuming is fixed based on all of the other assumptions we've made about taxes and government spending and output being fixed. So this is S bar, so it's not dependent on the real interest rate. So the impact of the policy, if we have a change in taxes such that consumers want to save more, what we'd expect to see is an increase in savings. So in other words, savings, the savings curve would shift to the right. So let's call this S bar prime. So here's investment and investment prime. So here's the initial equilibrium and the second equilibrium. So I'll just call this E1 and E2. So at the initial equilibrium, we go to the y-axis to see what the level of the real interest rate is. So we can call this R. After the shift in the savings curve, we have R prime. So we can see that the interest rate has gone down and the level of investment has gone up as a result of this increase in savings that was driven by the tax policy change. So if you're seeing this potential change, debated in the news, should we pass this policy or not? Well, if you're a macroeconomist, you might very well come to the conclusion that yes, this is a good thing because in the long run, it's going to put downward pressure on interest rates, which should encourage more investment. And of course, investment spending is beneficial to the economy in the long run because we are becoming more productive, which will increase the standard of living ultimately. So that about wraps up what I had to say for the second part of Chapter 3. So please, again, let me know if you have any questions and, reach out via email or the discussion board on D2L, and I would be happy to sit down with you and take some more time to go through the details.